Thank you, Tomas, and thank you to our hosts at the Mining Investment Event of the North. Denison is certainly situated in the north. Our primary asset base is in northern Saskatchewan, and we actually have 70 years of uranium mining. So operating in the north is what we know and what we've known for a long time. Certainly today we'll be making forward-looking statements. Just caution you to advise and review the advisories. What I think is particularly exciting about our asset base, and it's not an asset, it really is a portfolio, is we offer, in our opinion, superior and really the best leverage to uranium within the Athabasca Basin. I don't have the details exactly, but this morning we're happy to see that the Mining Journal actually identified our flagship Wheeler River project as the #1 development stage project in the world. And so while we think it's certainly spectacular, it was certainly encouraging that others had recognized that as well. With the Wheeler River project, this is the largest undeveloped project in the infrastructure-rich eastern portion of the Athabasca Basin. For those that aren't familiar with uranium, Athabasca is a long-time established mining camp in northern Saskatchewan and really the preeminent global basin for uranium mining. The Wheeler River project is one that we've been advancing for many years. It consists of two distinct deposits. The first, Phoenix, which is called the flagship among the flagship assets, is a in-situ recovery. So ISR is really a known and proven mining method, but one that nobody else has brought to Athabasca before. So certainly we're innovating from that perspective. Our second deposit at Wheeler, Griffin, that's a traditional underground drill and blast operation. So at Phoenix, we've been de-risking the ISR as the first ones to bring ISR to Athabasca really for the last 6 years through progressive studies. We had a successful field test in 2023 where we recovered uranium from ISR mining for the first time in Athabasca. We followed that up with a feasibility study in 23. We've started long lead procurement, advancing on project financing. Detailed design was initiated this year, and really are moving this project forward to make a final investment decision in mid-25. We have a 2-year build, so we're targeting first production late 27 into 28. The next asset in operation I want to talk about, the McClean Lake mine and mill. And this is a mill that's certainly well known within the mining space. It produces 11% of global uranium. Importantly and notably, Cameco Cigar Lake operations, all of its feed goes through there. This mill is the only one that processes third-party ore within the basin. So when we think about having strategic infrastructure, this really is a strategic infrastructure asset and one that we think is going to be important for unlocking value through the rest of our portfolio. We did surprise the market a bit this year, and we're happy to do so when we announced the restart of mining. At the McClean Lake operations, there actually are unmined deposits. Mining took place between 96 and 2008. When the market turned, there were some smaller deposits were shut down. That really didn't make sense with conventional mining methods. So over a number of years and at great expense, Denison, along with our partner Uranium, which is the French nuclear giant, we developed the proprietary Sabre resource extraction method, which is really effectively water jets from surface and cutting up rock and then sucking it back up specialized pipes. And so that's been de-risked and brought forward to a certain level that we're confident in restarting operations next year. While the production is small, 100% of operations being 800,000, we certainly think it's indicative of the value that we can create with assets that others may have overlooked or not been able to realize value from. And so with the first two operations we're talking about so far, each of those would be unique tools within the toolkit, both ISR and Sabre, to really develop uranium assets in the basin. Waterbury Lake, this is the second project that's had a successful ISR field test in the Athabasca Basin, Phoenix being the first. And again, it shows how we're trying to use proprietary and new novel thinking to develop resources that others may have passed or not been able to fully realize the value from. Beyond those three, We have a large portfolio, over 385,000 hectares within the basin, including notable projects like Midwest and Millennium. So where do these assets fit globally on a cost curve? We're happy to be able to show 3 Denison operated projects that would all be considered tier 1 assets from a global perspective. I mean, Phoenix at Wheeler River at $16 all-in costs, and all-in being initial CapEx, sustaining CapEx, OpEx, closure. If we put that in context of a $90 uranium price, certainly that's significant margin potential. And then if we look at the other projects that surround it on the lowest portion of that cost curve, you'll see the 3 gray bars all being ISR. So in situ recovery is the lowest cost form of uranium mining, and certainly having the lowest cost non-Kazakh asset, we think probably contributes to one of the reasons the Mining Journal identified us as a top development asset globally across mining commodities. But also our Wheeler River project, while it's not ISR, as an underground operation, it compares very favorably with world-class assets. The light green arrow, that's NextGen's project. It's a phenomenal deposit, as are the other 2 green bars, Cameco's McArthur River and Cigar Lake. So we really see us having the platform to create a multi-asset, low-cost intermediate producer. So one might ask, how does a development stage company take on an ambitious task of developing multiple assets? Well, we're very comfortable that we have the financial firepower to do so. Our balance sheet is over $400 million, consisting of cash, working capital, notably physical uranium and investments, and importantly, 0 debt. The largest piece of this balance sheet is our physical uranium. In 2021, at $29.66, the company acquired 2.5 million pounds of uranium. That's tripled in value to where we are today, and really has significantly reduced any financing needs we have going forward. That, combined with $120 million of cash on the balance sheet, really have allowed us to advance into the early production procurement phase, continue de-risking, and give us a great degree of balance sheet strength and confidence as we move these projects forward. So now just drilling in a little bit more into Phoenix and perhaps why it was identified as such a top project. Recall we said ISR is the lowest cost mining method for uranium. Traditionally, when ISR is utilized, it's at very low grades, sometimes called 0.05% uranium. Well, Phoenix has ultra high grades at 46%, within our high grade area, which is the majority of our deposit. So we're talking about, 500 to 1,000 times the grade profile of a lot of other ISR operations globally. So when you have a low cost method with ultra high grades, and we all know grade is king, you get superior economics. So we're proud that we have $1.5 billion NPV, and that's done at a much lower uranium price than we are today. A 90% ISR, and importantly, call it capital efficiency with a 3.7 to 1 NPV to CapEx ratio. And for context, again, $16 all-in costs, $6 cash costs, and that's even lower in the early years. So when you have a $6 all-in cash costs, production that quickly ramps up to 9 million pounds a year, you can see how there's significant cash flow generation potential. And so based on our feasibility study, and again, lower prices than we are today, 100% of the CapEx is paid back in 10 months. We are not going to borrow 100% of our CapEx. We've borrowed none so far. So when we think about how long we may be paying back any debt or repaying the capital, we're talking a matter of months after we start production. So really that positions us uniquely to be able to build those subsequent assets and having that capital available. The next in queue, 3 kilometers away, also at the Wheeler River property, is the Griffin deposit. This is certainly a distinct operation, conventional underground. The picture you see here is the McLean Lake Mill. And so while 1.7% grades is in itself high grade, it obviously is not 46% we have at Phoenix. But when you have an infrastructure-rich location with road and power already running parallel to site, there's going to be a camp and other infrastructure we're bringing to Wheeler through our Phoenix development, a mill that exists in place in which we have an ownership stake. you start to really chisel away at that CapEx number, and it becomes a very attractive operation and really synergistic, and that's how we view our portfolio. And at $25 all-in costs, again, one that we can make significant returns on. I'm going to talk about one more asset today, and this is our Midwest project. It really is a sleeper within the portfolio. It's a 25% owned joint venture, again with Orano, and so this is a similar ownership split that we have with Orano at the mill. It's located 25 kilometers away from the mill, so certainly the ability to have this ore processed at the mill is how this would be envisioned. And why I want to bring it up, on Monday we announced the third successful ISR test on a project within the Athabasca Basin, which confirmed hydrologic connectivity within the basin. Also some permeability enhancement tools that we've explored have shown success. And what that really has led us and our partner Orano to do is to support continued evaluation of ISR at Midwest, and we'll be advancing towards a PEA, and excited to be able to show the market some of the economics that we think are really going to be more attractive than how one may traditionally view a pre-production resource from, call it a dollar per pound resource perspective. In terms of the uranium market, for those that aren't familiar, I'll just be really brief. We exited a period, or exiting a period post-Fukushima, where there was significant glut of inventory, and really the marginal cost of production was not in any way connected to price. If you're living on excess inventory, that can only be something that exists for so long. The uranium market is operating in a significant deficit. It's a 30% supply deficit. And so every year that inventory continues to be drawn down, and that's really what we're seeing driving this big price inflection as we're starting to move closer to how traditional commodities are priced, which is a reflection of long-term cost of supply and demand, and how much supply do you need to bring on, and what's that marginal cost to incentivize new supply. And given a long period of underinvestment, we certainly think that incentive price is quite high and will continue to support robust markets moving forward. I'm just going to leave this slide up and pause. I don't know if anyone has any questions, but I'd certainly be happy to take any from the audience.
Thank you. What would the correct incentive price for you, like if you were to think about it and put it dynamically, maybe going the chart over, if you can, just your thought on, sorry.
Yeah.
Or, yeah.
Oh, I'll go back. Yeah. So,
but if you can answer that question, so what, where you believe, the market should be clearing, and that it'll balance the market.
Yeah, well, this chart is certainly instructive to know, ballpark where you should be thinking. If you look at the bars to the right side, all those assets, Immerern, and even on the top, that's supply that's needed. That's in Niger. A lot of the other orange bars, all Africa. You have high-cost African assets that are, costed on a pre-inflationary environment, and that does not include any incentive price. Frankly, we need projects that are higher costs that aren't on this chart to really balance the market. So is there a price? I mean, it's certainly 60 plus incentive plus new projects that are higher cost. We think it's going to be continually well supported. I can tell you I just came from a utility conference on the nuclear space earlier this week, and the big concern is where are the mines coming from? And it's all over the world. You're going to have to take on geopolitical risk. There's going to be higher risk assets. I don't think we've truly tested what the true incentive price is, because I'm not aware of a project that isn't, that's identified, that's real from a technical perspective, that's been annexed because of cost. Okay. Well, thank you very much.